What's going on, wealth creators? Matt AS here. Welcome to part 2 of our video breakdown, going through a video that the Money Guy Show did, exposing infinite banking. And there's some good information in it. A lot of it is very misleading, kind of half-truths about infinite banking, dividend paying whole life insurance, etc. So that's why we are breaking down the video, just to provide some clarity around the topic of infinite banking, because it can be an incredibly powerful financial strategy for certain people. It's definitely not right for everybody, of course. But as always, the issue I have is not necessarily that people disagree with infinite banking, it's that they're providing inaccurate information, and that leads people to make uninformed financial decisions. And that can have pretty nasty consequences later on down the road. So let's go ahead and jump in. I want to continue. One thing I did want to mention too, just one of the other benefits of infinite banking that I forgot to mention in the first video that I probably should have, is also especially when comparing term. I'm just trying to share my screen here as well at the same time. But another benefit too, later on down the road, is you're building wealth, you're letting these policies grow, and eventually they can also provide a supplemental tax-free retirement income as well, and also provide a really good volatility buffer for your retirement as well. Which is very important. You're not going to get that with term insurance, and it can also be a problem if you're quote unquote try to be self-insured. Like if you don't have a volatility buffer, that's a whole other conversation. But my point is, these policies, we're using them to build wealth, implementing the infinite banking concept, but they can eventually be really, really valuable in retirement as well, where you've paid them up, you're not making premium payments anymore, and there's no cost of insurance due or anything like that. And then you can basically use the policy for additional income, volatility buffer when the market goes down. You don't have to tap into your 401k, IRA, whatever. You don't have to sell those assets off at a loss. Makes the value of the account go down even faster. You deplete it that much faster. You're able to tap into your policy during those down years, let the portfolio recover, and then you resume taking withdrawals from those accounts. So it's a really good volatility buffer. And you can also change your dividends from paid up additions to paid in cash. Now you get a little bit of extra retirement income as well. It's tax-free up to your basis. So I just wanted to point that out. I did mean to, I did want to talk about it in the first video. It's just a lot going on in the first video, so I wanted to bring that up. But yeah, let's go ahead and continue. We'll try to get through the rest of the video in this one, so I don't have to do a part 3, but we'll see how it goes. More importantly, I just want to make sure that we are covering all the points here, so you have the information that you need to make the best decision for you.
Sure, commercials. Everybody always says you put all this money in, but here's the benefit over investing. You get access to your money completely tax-free. Mm-hmm. How in the world? I mean, because you're making this thing sound like you're just paying for a lot of life insurance. Right. How am I going to get access to my money tax-free, as I've often hear people talk about?
So when we think about the cash value increase, and you're dumping this money in, and we look at the average dividend rate, the 10-year average dividend rate on cash value policies is somewhere around 5 to 6%. Some companies a bit lower.
Which, just to clarify, guys, that is a gross number. I'm actually not a big fan of using the dividend rate like that. The dividend rate of a company really shouldn't really play a very big part in your decision or your decision to go with any particular company. That's a gross rate. So just because a dividend rate is 6%, that does not mean your policy is going to grow by 6%. That is a gross number. There's going to be fees, cost of insurance, and all that stuff. Like I said in the first video, these policies typically net 3.5% to 5% tax-free compound growth, where current dividend rates are. If those dividend rates go up, then obviously that internal rate of return can go up. But yeah, that's just a gross number. Don't let that be a very big part of your decision with these policies, or which company to go with.
Lower, some companies a bit higher. But the thing that makes this exciting or gets people excited about is exactly what you said. You actually have the ability to take loans from the policy. So if you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods or to go buy products or go do fill in the blank. You are borrowing money from those copious amounts of cash that you've paid into the policy to build up that cash value.
No.
Okay, so that's typically how people will create a supplemental tax-free retirement income. I don't think that's why you should set the policy up. It's not really what life insurance was intended to do. you have to make sure you fund the policy correctly. You have to make sure you give it enough time to mature and get more efficient, et cetera. And obviously be careful like how much you're taking in policy loans, because when you're taking retirement income in the form of a policy loan from a life insurance policy, granted, the interest rate, it is simple interest, but it will compound against you if you're not at least paying the interest, which is not necessarily a problem if you're not over leveraging the policy, you're not taking too much, all right, and you funded it properly, given enough time to become more efficient and mature. Eventually, when you do pass away, then the death benefit is going to cover the loan balance, and then whatever's left will be paid out to your beneficiaries, right? So it's not really a huge issue. I just got to manage it. That's all. But the other way to get tax-free retirement income from the policy is what I was just talking about, where you can change your how your dividend, like what happens with your dividend, to paid in cash, and that can be tax-free up to your basis. And then once you reach however much you've paid into the policy, then you can start taking policy loans. You probably won't get as much from the dividend, like using that strategy, than you would doing policy loans. But it's still a really good supplemental income stream. Like it shouldn't be, life insurance should never be the main source of income for your retirement, in my opinion. I don't think that's a very good idea. It's not what these policies were intended to do. This just happens to be a really good additional benefit later on.
Now, wait a minute, because I'm already, my spidey senses are starting to tingle a little bit here. And the fact that leverage is not something that taking on encumbrances don't tie into financial independence, because those two words, independence, encumbrance, those just don't work. How are you going to make this work where I'm taking loans? Because aren't I paying interest rates on this stuff, Bo? I mean, there has to be a catch here.
That's exactly right. So a lot of these loans do indeed have interest rates that you're paying. Now, before we go into the interest rates you pay, there are two different types of loans you ought to know about. There are what are called direct recognition loans, which means when you pull the money out, you don't earn any money. You don't earn any dividends on the money that you've pulled out. Well, then there are non-direct recognition loans where you do keep earning dividends on all the cash value, even what you take out as a loan. So again, I'm trying to think.
Yeah. So that's why, I mean, I don't like to overcomplicate things, guys. I just always go with non-direct recognition. I'm not trying to mess with direct recognition, where like usually people are trying to get positive arbitrage and stuff like that with direct recognition. I don't play that game. I always just do non-direct. I want all of my cash value growing all the time, even when I take a policy loan. Like that's it. Like I don't want to overcomplicate anything.
Think about this in terms of banking. On direct recognition, if I put money in my savings account and then I go to pull the money out of my savings account, I no longer earn interest on that money that was in there. With non-direct recognition, it's like I can pull the money out, but I'm still getting that. However, you've already alluded to this, these loans do bear interest. Well, if you now have an interest rate you're paying on the loan that's greater than the dividend that you're receiving in the policy, it does not work. It falls.
Wrong. Wrong. Okay, this is really important, guys, because when you hear that, it sounds bad, right? So like if so my policy loan rate right now is 5.5%. If my policy only grows by 5% and I stop there and I don't tell the rest of the story, that sounds really bad, doesn't it? Well, of course it does. And that's where they stop, like with that conversation. Maybe he goes into a little bit more, but he's saying like that doesn't work. And that is not true. It's a fundamental misunderstanding about how compound interest works versus simple interest. All right, I've done plenty of videos on this. I'll link them down below. But basically, like I ran maybe I'll just do it really quick. I'm just going to break it down. I'm going to link down to the video where I break down the actual numbers of this. So make sure you check it out. But I've run numbers where like when I borrowed from my policy to purchase my car, for example. All right, I mapped it out where like I could pay 8% on the loan and only earn 4%. Like, okay, back up. I could pay 8% simple interest on the loan and only earn 4% compound interest. And in 5 years, which is the typical car loan term right now, in 5 years, the compound account will be ahead. You'll actually be ahead, that even though the interest rate is half of what the policy loan rate is. And it's because of the difference between simple interest and compound interest. With simple interest, the payments or the interest is being applied to a lower and lower balance every single time you make a payment. With compound interest, that interest is being applied to a higher and higher balance every single time it's credited. Okay, so when you look at the actual numbers, you could pay a policy loan rate of 8%, only earn 4 in the policy, and over the long run, you're going to come out ahead. Not to mention, that's not why we set the policies up anyways. We're not trying to get positive arbitrage in the policy, all right? We are trying to set these policies up because they're extremely efficient savings vehicles, great places to store large amounts of capital for emergency and opportunity funds. But then we're going to use the policy to go make money, to continue building wealth like we normally would. So I would ask you, does it make sense if I borrow from my policy at 5.5% and I lend it on a piece of real estate at 12% plus points? Does that make sense? Why wouldn't I do that all day long? And my policy is still growing at that 3.5% to 5% tax-free compound growth while I'm doing that. What on earth does not make sense about that? How does that not work? Right? See, this is my problem. This is the problem with this type of content, that and the things that he's saying right now is he stops there. He says it doesn't work because if you pay 6 but you only earn 5 or whatever his example was, this doesn't work. Yeah, it does, because we're talking about the difference between compound and simple interest. In the policy, we're getting compound interest. On the policy loan, we are paying simple interest. There is a massive, massive difference, guys. So I wanted to clarify that.
Falls apart. So there's another feature, because these insurance companies that think of everything, where they make available what are called wash loans, where you can go take a loan out of the policy and you can guarantee that the rate you pay in the policy matches the dividend rate so that it doesn't flip upside down. But as you can imagine, if you're trying to get one of these policies that has non-direct recognition loans.
Yeah, usually wash loans are, maybe whole life companies do that, or whole life policies offer that. I'm pretty sure that's just with like indexed universal life and universal life policies. That's where I typically see wash loans, but maybe they're on whole life. But again, I don't mess with any of that. It's just always non-direct recognition.
Loans, and those loans even operate as wash loans. What's likely going to happen is either the costs and fees of the policy are going to be greater, or the rate of return they're willing to give you through the dividend rate is going to be lower. There's going to be a cost somewhere.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean, my head's spinning a little bit on this. So because this is not anywhere that I'm seeing on social media, maybe we ought to take a few steps back and at least.
Because to be honest, for me, you don't really need to know the major difference. Like the question is, do we want our money to continue compounding in the policy while we use it to build wealth? If the answer is yes, just do non-direct recognition. And that's going to be the case 99 times out of 100. So we don't really need to dive into all the details about the difference between direct and non-direct recognition. If you're doing an IUL and they show you participating loans versus wash loans and all that, that you do want to know, because that's going to have a major impact on the policy later on. Not even just later on, typically later on, because IUL agents will talk about using wash loans when you start taking income, but they never illustrate that. It's a whole other problem with IUL. But anyways, non-direct recognition is the way to go.
Why don't you bring this back to what are the benefits they're at least telling me I'm going to get out of this? Because right now the details are making me feel like I'm swimming upstream on this. So at least let's break it back in a little more elementary. Tell me what the brochure says the benefits are.
So let's look at the brochure. Very first thing, we already said this. They tell you, hey, the dividend rate will be 5 to 6% or more each year. And if you look at the 10-year
again, that does not mean that's what your policy is going to grow by. It's just that's a gross rate. So anybody trying to sell you a whole life policy based on the dividend rate, I guess it's good to know, and especially like if dividend rates are going up, but just always remember it's a gross number. That is not net of fees and costs and things like that.
Dividends. So you can think about that kind of like interest rate on your savings account, dividend rate on your cash value, somewhere around 5 to 6%. Returns on the policy are guaranteed. So that's not like investing in the stock market. In the stock market, the market can lose money. It can go down. If you have a cash value, whole life, high dividend paying policy, there's likely going to be some guaranteed rate in there. So your money can't go down in value.
Yeah, typically it's like 2 to 3.25% right now is the guaranteed rate. And then you would get dividends on top of that. Dividends are not guaranteed, but these companies have never missed a dividend payment.
So a lot of people like the security around that. So that's another brochure.
There's got to be a catch to that. I know you're going to cover the catches in a minute, but there's got to be a catch to tell me I can make 5 to 6%.
Nope.
Guaranteed. Because we have.
No. And see, that's the problem with this kind of language, guys. That he's not saying that the 5 to 6% is guaranteed, or who provided that information. And if he is, it needs to be clarified that that's not the case. There's a difference between the guaranteed rate and the actual dividend. It's basically combined. So like you have your 2 to 3.25%. That's the guaranteed rate. And then on top of that, you would get dividends, which would be that 5 to 6%. But again, it's a gross number. So typically, like I've said before, these will net 3.5 to 5% after costs and fees, et cetera. But saying that you're going to get guaranteed 5 to 6%, that is not true whatsoever. It's very misleading.
Have it in all caps for a reason.
Yep.
There's got to be something more to it.
Let's keep going with the brochure though, because the other thing to say is, hey, not only do you build this cash fund, not only do you have this capital that you can use, life insurance also offers protection for your loved ones in case something were to happen to you, and it's there forever. It doesn't go away at some point in time. So not only do you have this bank that you're building where you can get the money out.
Forgot to reshare the screen.
But your beneficiaries, your loved ones are taken care of if something were to happen to you. And I think this is the biggest benefit that people really, really dive into this. Your money will be accessible when you need it. Unlike a 401k plan where you have to wait till retirement, you can't access it until you're old and decrepit. So this.
Okay, so I don't really like that argument. I mean, the liquidity for a 401k is an issue. It's one of the many reasons I'm not a fan of 401ks. But I mean, you can access money in a 401k. You're going to take a penalty, pay taxes. I know you can take loans against a 401k as well, but there's restrictions, and you have to be careful too. I mean, if you lose your job, what happens and you have an outstanding loan balance against your 401k, does that come due? Like, you need to know what that is. That doesn't happen with a policy loan on life insurance. So, there are big differences and pros and cons to each. I like to think there's way more pros than cons for life insurance, for whole life, versus 401k. There's a lot more cons than pros, in my opinion. But again, comparing a whole life policy to a 401k, I just don't think that's very productive. I mean, I guess it can be productive, but again, we're comparing apples and tater tots. That's all. Like, they're just completely different products.
This is what they say. Healthy dividend rates, guaranteed rate of return, life insurance protection, and you can get to the money you need.
We've done this all wrong because you spent the first 10 minutes going through all these definitions, complications. You should have started here on the brochure. This is good. I mean, I can get behind this. This sounds really good.
This should
5 to 6% guaranteed. I get life insurance for my family, and I can actually get access to the money. What could go wrong? This sounds perfect. I can see why this is what I'm finding on social media.
But now let's talk about the reality. In reality, only the cash value is growing at the dividend rate. So we're going to show you a case study in a moment where all that money that you're throwing into this whole life policy, not all of it's going to cash value. And so not all of it is getting the dividend rate applied to it, even in the early years.
Right. But when you look at the illustration, that is net of costs and fees. And, the illustration is not guaranteed, obviously, because dividends are not guaranteed and dividend rates can change. But what you see is net of costs and fees. So I'm not really sure why that's like what he's talking about is an issue.
Years, you're not really building up very much cash value at all. So
yes, okay. That comes down to policy design. Guys, when I set my policies up, I have access to like 88% of my cash value of my money in the first 30 days. And like it's typically 85 to 90% that you have access to. So what are you talking about? That's part of the story that's not told, is that you can custom design these policies for high cash value. You don't have to wait 3, 4, 5, 10 years, whatever, to get access to a good amount of cash value. You can do it in your first year. Within 30 days, you can take your first policy loan and go do what it is that you were going to do.
So maybe it's not as great as just a savings account right now paying 5 to 6. There's one piece. The second piece is, if you want some of these bells and whistles like non-direct recognition loans where you can take a loan and still earn dividends, or if you want wash loans where you can make sure you never have a disparity between the rate you're paying and the rate you're receiving, it's going to cost more. They're going to lower the dividend rate that you receive on that.
No, with non-direct recognition, no, they don't lower the dividend. It's right in the name of the title there, like non-direct recognition. They don't recognize that you've taken a loan, so they're just going to apply the guaranteed rate and dividends, whatever the dividend is, to the cash value as if you never touched the money, because you borrowed the life insurance company's money, not your own. Like, you didn't use your own money. So they are not recognizing that you are taking a policy loan, so therefore they are going to apply whatever the dividend is to that cash value.
These are all the things that have asterisks on them.
These are all the asterisk things.
Okay, keep going.
How about this one? Fees and expenses can eat into your return. Nothing we've talked about right now.
Everything on the illustration is net of fees, costs and fees.
Actually covers the mortality expense fees or the commission.
And like I said, typically these policies will net after cost and fees 3.5 to 5% tax-free compound growth
that are paid on these types of policies. That's a whole separate subject that we're not even broaching here. And then this one is a big one. Surrender fees typically don't go away until you've had the policy for at least 10 to 15.
Okay, he's talking about a universal life policy here, not whole life. Like there obviously, like, you know, within the first few years, like if you were to surrender the policy, you would take a hit, obviously. But when you structure them properly, you can break even in years 4 or 5, where like if you were to surrender the policy, you basically get back what you put into the policy. So if you don't design it properly, yeah, I mean, you could, you'd be 10, 15 years into the policy and still haven't broken even. Or, you know, same thing with IUL, like there's very long surrender periods. There's ways around that, but there's costs associated with it. So, you know, again, we got to make sure we're telling the whole story about these things.
15 years. So what happens is you're signing this insurance contract saying, yes, I'm going to perpetrate this strategy. But if I change my mind and I decide I want to move away from this, if I want to get out of this at some point in the future, I'm going to be penalized from doing that. Well, all of a sudden that makes it sound like, well, maybe this isn't my money. You know, at the bank, if I don't like my bank, I can pull my money out and I can go choose a different bank. With the insurance policy, if I decide to pull my money out, I get penalized for not carrying in my part of my part.
Because it's a life insurance contract. This is not actually a bank account. Right. We can compare it to a bank account because of it's not an investment, right? But it's not an actual bank account. No, you're buying life insurance, guys. So yes, it's going to be different than you being able to pull money out of the bank account. But again, there's pros and cons to everything. You got to weigh those pros and cons. What are the benefits that I'm getting from this? So if I'm sacrificing what I would get with a bank account as far as liquidity, where I could just take my money out, go to another bank, and it's not a big deal. Right. You could do that, but you also don't have any of the benefits that a life insurance contract gives you. So it's give and take. Like you're going to sacrifice a couple of things over here to gain so many more other things over on the other side. So that's the way
I want to go back to something we covered a little earlier. If the Consumer Reports found the average rate of return is 1.5%, that has to mean that people aren't getting the 5 to 6%. Because we even went and pulled back when Consumer Reports came out with the article, some of the dividend rates were actually up as high as 7%.
Yep.
So it's not like this is a different interest rate environment or things have changed a lot in that aspect. What I think is interesting when I started doing
what he's talking about is the difference between like 100% base policy and a custom designed policy. The design of the policy makes a huge impact on that rate of return, even though we don't set policies up for that. So when you see dividend rates, again, they're gross numbers, that's not net, but even when you see 6%, then you only see a policy doing 1.5. Well, one, how is it designed? 2, how long has the policy been enforced? Because if it's only been enforced for 10 years, well, yeah, it hasn't reached maturity yet. It hasn't had enough time to get to that 3.5, 4, 5% net. It takes a while for that to happen, but it gets more efficient over time, right? So again, we're missing some data with that number, but
doing a little deeper dive on this. If you need your money in the first 3 years, that surrender fee is going to eat you alive.
No, it's not. If you don't design it properly, sure. But I had access to most of my money within 30 days, guys. So it's just simply not true. It's half the story is what it is.
A lot of the initial premiums is going towards commissions and other things. So if
it's 100% base policy, yeah, that is true. But we don't set up 100% base policies for infinite banking. We custom design them. We lower the base, increase the paid up edition, so you get high cash value in the first year.
It's going to be a steep surrender fee. So that's controlling your ability to vote with your feet on the front end. And then if you live to be a ripe old age, and the back end is going to get really crushed because the cash value is actually going to be paying the much higher cost of insurance. Am I reading this right?
Yeah, that's right.
So you don't really, this banking on yourself actually has a lot of asterisks.
Okay, he's talking about IUL there. The cost for a whole life policy, they are level, guaranteed not to change. They are level throughout the contract. That's one of the reasons why whole life insurance is more expensive on the front end. It's because it's making up for it on the back end. So no, dude, costs are level in a whole life policy.
catches is what I'm hearing. And by the way, if I can, for all the people who say putting your money in a 401k is putting your money in prison because you can't touch it, this is a better way. How do you get past the surrender fee?
I just told you, custom designing the policy.
This Alcatraz. If putting your money in a 401k is putting it in prison, putting in this feels like you're putting in Alcatraz.
Yeah,
Something that can't be
this doesn't tie to what I'm seeing out there.
And then this is what you just alluded to. This money is locked into a complicated insurance product. So all of us can kind of understand, if I have my money in a bank and I have it in a savings account, I need to go get it. I can go get that money and I can get statements on that and understand what's going on. Well, now we have this alternative to that has a lot of asterisks, but maybe the numbers will be compelling. Maybe when we look at an actual policy that's actually been designed for this strategy, maybe then it's going to click. Maybe then we're going to say, aha. So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent. So let's assume that you have Infinite Banking Isaac. And Infinite Banking Isaac is going to put $10,000 per year into a high dividend, whole life paying policy in order to carry out infinite banking. That's what Isaac's going to do. And so the dividend rate we're going to assume, which is the dividend rate as of right now in 2023, is 5.2%. And the non-guaranteed values assume that this rate stays constant for the entire life of the policy. What we're saying is we're going to lock in 5.2%, and we're going to assume it does not go down even if interest rates fall. So we're trying to stack the deck in favor of the illustration. Make sense? All right. We're also going to say that by the time, since we're doing paid up additions, since we're buying more insurance, at age 65, the non-guaranteed cash value, this is from the illustration that an insurance agent actually provided for us, the non-guaranteed cash value will have grown to $532,000. The non-guaranteed death benefit at that time is $897,000 at age 65. Now, this is an important thing to mention. When Isaac first started buying this policy, remember the whole idea is I'm going to dump a bunch of cash in, I'm going to buy paid up additions throughout the life of the policy. When he first took the policy out at the very beginning at 36, it was only a death benefit of $196,000.
Okay.
So that $196,000 death benefit over the next 30 years grew to be $896, but it didn't start at $896 because I think that is something worth noting.
It is. Yeah. Your death benefit grows every single year with the cash values as well.
His cash value by perpetrating the strategy went all the way up to $532,000. So the question
now, also, there's an issue here, though. Again, it goes back to design. The fact that he's saying that the death benefit was only $196,000. That tells me that there was not a term policy put on, or that there was not term put on the policy to avoid mecking the policy, which means it probably was not structured for high cash value. So I'm going to guess, just go out on a limb here and say, like, if they actually bring up the illustration, they're probably only going to have access to like maybe half, if that, of their cash value in the first year. We'll see. But normally you want to add a term policy on top of the whole life policy to avoid mecking it, which would it's modified endowment contract, which would make you lose all of the tax advantages of the policy. So we artificially raise the death benefit with term. That eventually falls off, usually 7 to 10 years, but that obviously significantly raises your death benefit. So the fact that that's not there, I'm already questioning this example.
Question is, what does his investment return look like?
Now,
you don't set this up for return, guys. I don't know how many times I can or need to say that. Hopefully I don't need to say it too many more times, but we don't set these things up for rate of return. That's just a bonus. We set them up to give us more control of our money, to get the maximum amount of benefits for our money, to solve multiple problems with the same dollars, and then use those dollars from the policy to continue building wealth like we normally would. The net 3 to 5% is just a bonus, in my opinion.
Before you give us the aha moment, I want to make sure I put it out there. First of all, thank you to the life insurance agent that was willing to come forward and just share it with us. I mean, because it's hard to get information on these type of products. So to actually have somebody come and say, hey, I use these. I think I'd love to get your take on it and share it. We're not doing this just to straight up just rip it up. Mm-hmm. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. So with all that, and then thanking the insurance agent, what's the rest of the story? So
here's the rest of the story. Over this 30-year time horizon, if you look at the $300,000 that was paid into the policy and the guaranteed cash value of $532,000 and guaranteed death benefit of $896,000. The actual rate of return that was received in this policy, 3.62%.
I don't know about you guys, but for a savings vehicle that allows you to use the money to continue building wealth like you normally would with all of the other benefits that we get, that is a pretty good, darn good savings vehicle, return for a savings vehicle. And again, if you're so confident in the stock market, why not set this up first, take the money out of the policy, then put it into the market? Now you're getting positive arbitrage plus the compound growth there within the policy. I don't recommend doing that, obviously, but like if you're so confident in the stock market, why not do both? This doesn't have to be an either or conversation.
Over this 30-year period, when you think about the return on capital that was deployed into this policy, 3.62% does not get me super, super excited. And this assumes you didn't actually.
It shouldn't, but you're also not talking about all the ways, like what's the rate of return on the investments that he made using the policy? Because I'll tell you, I just closed my first investment using my policy. It was a 40% annualized return. I flipped a piece of heavy equipment. We made 6.5% in 10 weeks. Annualized out, that's 40%. If I do that multiple times throughout the year, I mean, I'm crushing inflation at that point. Are you talking about that rate of return? How about the external rate of return that nobody ever talks about with these policies, right? External rate of return, meaning the peace of mind that you have, knowing that you have this really, really strong financial foundation in place that serves as an emergency and opportunity fund. It's going to continue to grow every single year for the rest of your life. All right. As long as you have the policy, that is. It's safe from creditors. It's safe from the banking system. It's with a company that has never missed a dividend payment in 146, 150 years, right? Like what's the rate of return on that? You know, so again, we're only telling one part of the story here, and it's not very productive when it comes to making informed decisions about whether or not these financial products make sense for us or this particular strategy makes sense for us. He's just stopping here, right? What about all the other rate of returns that are part of setting this system up? No, don't talk about those.
Use it for the number one benefit that's touted from it, which is borrowing money from the policy through time.
And now, I know earlier you showed it on the assumptions page. This thing was paying over 5%.
Mm-hmm.
So for it to have returned 3.6, is that because it's back to what you said? You're only earning off the cash value,
Yep.
and then there's.
It's right. It's net of costs and fees. That's why the dividend rate can be a little misleading. Your policy is not going to grow by that amount.
That's net of fees and all the other things
Exactly
that are
right.
coming
There
through.
are fees coming through, and then a portion of that every single year, every single month is paying for the insurance. So it's not like you had all $10,000 working for you.
Correct.
Or all $10,000 having that 5.2% dividend rate applied to it. Now, again, these are not numbers that we did. This is from an actual insurance policy. We just calculated the rate of return, 3.6% over the 30 years. So then the immediate question we have is, might there be a better alternative? Might there be something that looks different? If we were not going to do infinite banking, what would the Money Guy team do? How would we approach this? Well, we said, all right, let's look at Manny the Mutant. And you guys have seen Manny the Mutant a few times on the show before. And let's assume that Manny wants the exact same protection as Isaac.
All right. So yeah, here we go. They're going to talk about the buy term and invest the difference scenario, which listen, guys, I'm not a fan of it. I don't think it's a very this is the way I'll put it. It's not in alignment with my goals, my situation, what I'm trying to accomplish. But that doesn't mean it's bad. That doesn't mean it's a scam. That doesn't mean you shouldn't do it. You should weigh the options here. All right. Learn how both sides look. If we're talking about just buy term and invest the difference and infinite banking, with whole life insurance, right? If we're talking about those two strategies and scenarios, okay, learn everything you can about them, how they operate, what the pros and cons are, what the benefits are, advantages, disadvantages, and then make a decision. Okay, buy term and invest the difference might make sense for you based on your lifestyle, your situation, your goals. For me, I want nothing to do with buy term and invest the difference. It doesn't make sense to me at all. Infinite banking, dividend paying whole life insurance, 110% works for me based on my lifestyle, my situation, my goals. Okay. But I only came to that conclusion by doing my research on both sides. Right. So I don't think I'm going to finish the rest of it. We'll get into this example a little bit. The reason I wanted to do this video though, is to break down the infinite banking side of it, because there was just so much misleading information about it. Buy term and invest the difference, I'm just not a fan of. We'll go through a little bit, but I'm probably going to wrap this up here in a minute.
But he's also going to just invest the remainder in the stock market, right? So Manny, a 36-year-old male in excellent health, goes out and gets $1 million 30-year term policy, right? And I say $1 million because at the end of Isaac's policy, it was worth about $896. We kind of rounded up. 30-year policy, $1 million of coverage. It's going to cost him $788 per year to have that term policy in place.
Now, right out of the gate, he's going to have a lot more life insurance protection
for the whole time
than the whole life. So he's
So again, this is just misleading because you can add a term policy on top of the whole life policy, which you typically do. Like, I'm not going to get into the exact number that of death benefit that I have with my policies right now, but I'm in the first year of both of them. And my death benefit is pretty significant because I added the term policy on top of my whole life. So we got to tell the whole story here, guys. And then also, like, what, yeah, well, you know what, let's just, I feel like I'm beating a dead horse here. Like when he's talking about the 30-year term, again, he's only talking about the death benefit here. What are the benefits do you get from the term policy? I mean, it's just the death benefit. I'm not downplaying that is important, but if we're talking about infinite banking and all the things that it can do with this policy, well, we need to tell a full story here.
Now, right out of the gate, he's going to have a lot more life insurance protection
for the whole time
than the whole life. So even though he's only paying $787 versus the whole life is paying $10,000, he's going to have almost 5 times the coverage.
That's exactly right. Instead of 196, he's going to start with $1 million. And then we're going to say, okay, well, we're going to have the same cash outflow as Isaac. So he's going to invest the remaining $9,212 into the market and earning 8%. We're just.
Oh my God. See, this is where I really start to lose my patience with this kind of stuff. Earning 8%. Where'd you get that number? Where does that come from? And he's going to earn 8% every single year, guys. Average rate of return is such a scam. That to me is actually a scam. It is not a good way to value, or it's not a good way to create financial projections whatsoever. I've run the numbers on this. I will link the video down below. Please make sure you go through it. Average rate of return is extremely misleading. It overstates gains and understates losses throughout the entire time frame. You would be amazed at the difference in the ending value of the account. Like I did this, I did from the year I was born, 1988, up until the end of the beginning of 2024, taking every single percentage gain or loss of the S&P 500. I put $100,000 to start just to keep things simple. Didn't add anything else to it, whatever. And I wanted to see what it would look like at 35 years old, or in 35 years. And then I divided that by the number of years. It came out to like a 10 or 11% average rate of return. And then what I did is I took $100,000, I plugged that into a compound interest calculator at 11%, because that was my average, right? I earned an average of 11% throughout that time frame. And there was like a $1.1 million discrepancy. It was like $2.9 million in the compound interest calculator. There's like 1.8 million when you actually calculate the ups and downs, the volatility of the market. So using something like just assuming 8% is extremely misleading.
Just going to use an 8% rate of return for a 36-year-old investing for the next 30 years. How does this play out? Well, there would still have been a $300,000 capital outflow by Manny, but at an 8% rate of return on the dollars that were not buying the life insurance, right? That were not buying that, the $9,200 that was going into the market would be worth almost $1.2 million.
No, it wouldn't. It wouldn't be anything close to that. Watch my video on this, guys. I'm going to link it down below. I'll put it towards the top. Please watch it, because this is so misleading. It's not going to be anywhere close to that, because it does not account for the losses. It does not account for the lost opportunity cost, where not only did your account value go down in one particular year, now you have to get back to break even just to resume the compounding effect, which is not true compounding. And then you lost whatever you were supposed to earn in that compound interest, because the value went down instead of going up 8% every single year. So you're not going to end up with anything close to this number in that scenario. Not even close. And that doesn't even take into account costs and fees for assets under management as well.
And from 36 all the way to 65, because remember, it's a 30-year policy, there would still be a $1 million death benefit in place for Manny the Mutant.
And then it expires and you lose it. Like you lose all your premium payments, you lose the death benefit, and oh, that's right, you're self-insured now. That's a whole other video that I'm going to make. Yeah, that's just nuts, man. That they just throw these kinds of numbers out. It's just ridiculous. So anyways, I'm going to wrap up there. I'm going to finish watching the video, and if I think, it's worth doing a part 3, I'll do it. But, they're going down the buy term and invest the difference conversation now, rabbit hole, whatever. And that's not why I wanted to make this video. I wanted to address the infinite banking stuff to clarify what they were talking about so that you guys have the actual right, accurate information that you need to make the best decision for you. Maybe infinite banking is not for you. That's fine. But you don't know that unless you have the actual facts and understand how these things actually work. Okay. Because if you make decisions based on information like this, you could be missing out on a great financial strategy that could help you accelerate your wealth building process. How do you know? Unless you really understand how these things work. So anyways, I hope this was helpful, guys. Drop some comments and or questions, feedback in the comment section below. Make sure you check out the other videos I'm going to have in the description and other resources. Please just continue to do your research, learn how these things work so you can make the best decision for you. All right. I wish you all the best as always to your success. Matty S is out. So now we'll talk to you in the next one.